The Central Bank of Kenya has called for coordination between fiscal and monetary policy measures to bring down lending rates. Central Bank Governor Kamau Thuge says monetary policy alone will not achieve the desired lending rate without addressing the government's fiscal pressures. Speaking before the National Assembly's Finance and National Planning Committee, he further explained that despite the recent reductions in the central bank rate and the cash reserve ratio, commercial banks have been slow to lower lending rates, as Jimmy Mbogo now reports.
Despite the central bank's move to lower the base lending rate, commercial banks are yet to transmit the full benefits to their customers. An issue that the central bank governor Kamau Thuge now says may continue to persist if government does not address its credit appetite, which has been blamed for crowding out the private sector.
The bank's not responding to your lowering the rate, the bank rate, central bank rate. You lower it, they don't take any action.
Unless we can contain the fiscal deficits, not only contain but continue to the fiscal consolidation that the Treasury has been, has been talking about, we will not be able to achieve the kind of low, stable interest rates that are required to really empower and drive economic growth.
Because really, the sad thing about this borrowing is that most of even the money that we are lending to governments is actually government money. Because your largest accounts are actually with government institutions.
Thuge's sentiments were also echoed by the Kenya Bankers Association, who also noted that from November 2024 to March 2025, banks have reduced lending rates by an average of 2.5%. However, the reduction has not been uniformly reflected in customers' loan due to the 30-day notice. According to the association, nearly 40% of their net interest income originates from lending to government, further disincentivizing banks from lending to the private sector.
So we're asking that would indeed make more sense and would indeed have better economic transformation even if your cost, your contribution tax was less, but your availability of lending to especially the private sector and MSMEs was high.
Reduces their CBR or increases it. It takes effect immediately. You are side. On your side, you are waiting for 30 days to go. Who gets the advantage of that reduction, which central bank has implemented, but you have given it a blind eye, at least for 30 days.
The agreements that banks have with customers, the loan contracts, are actually up to 30 days. So you tell a customer when the rate is moving, whether up or down, we will give you the 30 days notice. And that's a practice that we normally do.
30 days looks short when rates are going up, but looks very long when rates are going down. That's the asymmetry that we typically see.
The banking industry has also warned the lawmakers against considering reintroduction of interest rate capping laws, noting that it will further strain credit to the private sector.
I'm thinking there is a way in which, after taxing the banking industry in the manner we've been doing, that amount of profit should also be subjected to some taxation arrangement.
We had interest rate capping implemented between 2016 and 2019 when they were repealed. During that window, credit growth never went beyond 10%.
Jimmy Mbogo, Citizen TV, Nairobi.
The petroleum industry in the